Oil prices are climbing again, and that is putting the Federal Reserve back in focus. Crude has moved higher over several recent sessions, and traders are taking notice. Energy is not just a number on a screen. It feeds directly into gasoline prices, shipping costs, and manufacturing. When those costs rise, they push up prices across the broader economy. And that is exactly the kind of pressure the Fed has been working to stamp out. The central bank has spent more than a year raising interest rates to bring inflation back to its 2% target. Many investors had started to believe the hard part was over, that rates had peaked and the next move would eventually be a cut. Rising oil is now forcing some of those investors to reconsider. Markets are split. One camp believes the Fed has already tightened enough. Their argument is that the economy is slowing on its own and that inflation will keep drifting lower, even if energy ticks up for a while. The other camp is less confident. They worry that a sustained push from energy prices could keep inflation sticky and that the Fed might have to hold rates higher for longer or potentially raise them again. That second scenario is one markets had largely priced out. Now it is back in the conversation. You can see that tension playing out in asset prices. Bond yields tend to rise when oil climbs because traders mark up their inflation forecasts. Higher yields, in turn, weigh on stocks, especially growth companies, which depend heavily on cheap borrowing. Energy stocks are the exception. They tend to benefit when crude prices rise, which creates a split within the market itself. That divergence explains the mixed signals coming out of Wall Street right now. The Fed has been careful to say it will follow the data. Officials are not committing to any specific path until they see how the numbers come in. That makes the next round of inflation reports especially important. Readings on producer prices and consumer prices, which measure what businesses and households are paying, will carry extra weight in the weeks ahead. If those numbers stay elevated, the case for keeping rates high gets stronger. If they soften, the pressure eases. What this means in practice is straightforward. The oil market has become a leading indicator for rate expectations right now. When crude moves, bond yields tend to follow, and stocks react accordingly. Keeping an eye on energy prices alongside the upcoming inflation data will give you an early read on how the Fed's rate outlook is likely to shift before the official numbers land. This briefing is brought to you by First Financial News. Clear, daily coverage of the economy and markets at firstfinancialnews.com.